obviously a lot of trust has to be given to insurance, because that's something you should be having at the right age, and you should be continuing till retirement and even post that. So that is one very important aspect of financial planning that one should be considering. But having said that, now post-retirement strategy, how can one align that? Very important to finish off all your financial liabilities well before you decide to retire, or you get to know that you won't be having any other source of income and have to really rely on that particular investment portfolio. But how do we use that investment portfolio? Because we also need to protect our capital. At the same time, we have to make sure that our investments are growing, because we are withdrawing every month from that investment portfolio. So,
Right. So I think one is to keep in mind a simple rule that you should be withdrawing about 4 to 5% of your corpus every year if you want that corpus also to keep growing in line with inflation. What happens post-retirement? So that is the amount of corpus that if you create, that if your expenditure and all the needs that you have is say 100 rupees, then you multiply by 25. That's the amount of corpus that you need. Effectively, that is, you withdraw 4% of the corpus every year, and you create a portfolio. Today, you have, say, simple instruments like mutual funds from which you can start a systematic withdrawal plan. So based on the amount that you want to withdraw every month, you can give a standing instruction, and every month you will have a regular cash flow coming out of it. So I think that is one of the sort of simplest method that we advocate to our clients, that you build up a corpus and you get into a systematic withdrawal plan so that all your sort of monthly expenses are taken care of.
so Dhruv, what kind of asset classes you should be having your exposure in? Talking about the SWP phase, how much in equity and how much in debt? What should be the proportion according to you?
So the proportion again comes down to uh, how much is your expenses, and what we advocate that to start with something like 2 to 3 years of your expenses should be kept into a sort of a liquid fund or a debt fund, so that that money is available on tap. And thereafter, you can look at, retaining a large component into equity. Now, this depends on, how you have built up your assets. If you have built up over a very long period of time, and therefore, in the beginning, when I said in the accumulation phase, uh, you are investing in equities, and if you build up the corpus over a 10, 20 year period, that money which is lying in equity can remain in equity, but you pull out at least something like 2 to 3 years of your expenses from that into a debt fund or a debt product, because that ensures you have enough safety and liquidity in case the equity markets correct. The remaining portion can continue in the equity, and from those equity funds, you start withdrawing money. Correct. So the composition of the asset allocation would again then depend on the investor's, risk profile. Is he very worried? Is he very concerned? Is he able to withstand, short-term volatilities of the equity market? So then it would get into, individual personal assessments, risk profile of the person, his other circumstances, and broadly a combination of equity and debt. And today you have products where the combination is already available. There are funds which are, a combination of equity and debt, and in different proportions. So assessing the investors' preferences, his needs, and it becomes a very individual planning as to the actual, asset allocation, the proportion between equity and debt.